heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, from Tesla to Netflix, we're going to wrap up the week of tech earnings and, of course, push ahead to the big names reporting ahead. Much more to come.
Plus, we'll sit down with the head of KKR's Tech Growth Fund to discuss where his firm sees opportunities in technology after they just raised $3 billion.
And we're going to wrap up our coverage from New York Tech Week and hear from two venture capitalists on where they're choosing to invest. Let's dig into what President Biden himself was saying last night in a direct appeal to the American people to support funding for Israel and indeed Ukraine's war efforts. Take a listen.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it. Tonight, there are innocent people all over the world who hope because of us, who believe in a better life because of us, who are desperate not to be forgotten by us, and are waiting for us. But time is of the essence.
We want to discuss this further with Nick Wadhams. And over in Washington, Nick, it is a moment where, of course, President Biden is appealing for more funds to be allocated at a time where there is no Speaker of the House. But bring us up to speed with really the concerns we have about an escalating conflict across the Middle East.
Right, so that's the big question on everybody's mind right now. We're expecting that Israel could launch a ground invasion into the Gaza Strip really at any time. And the U.S. is saying they want to show their full support for Israel while also wanting to avert a humanitarian crisis or a further humanitarian crisis that could further exacerbate tensions in the Arab world and potentially draw in Hezbollah fighters and maybe even Iran. So you saw the president ask for another more than $100 billion in funding. Last night, that money would go primarily to Ukraine, but there would be about $14 billion for Israel to supply it with munitions and other weaponry aimed mostly at missile defense. So the concern there is that Israel's Iron Dome system would be overwhelmed in the event that Hezbollah really launches a full-scale missile attack. So a complicated and tricky tightrope for the president to walk to both pledge his support for Israel but hope to avoid that burgeoning humanitarian crisis.
Nick, you lead our national security coverage here at Bloomberg, and this show is Bloomberg Technology. You talked about Iron Dome. In real time, broadly across the Middle East region now, there is literally conflict. The United States has bases in several countries where they are dealing with missile attacks and thinking about the response. They are engaged in sort of active military operation. Could you just explain to our audience what is happening across the region on Friday as we speak, but also heading into the weekend?
Well, the primary issue, obviously, is that impending Israeli ground invasion. But you did have this situation yesterday where the U.S. reported 3 incidents where drones, they noticed what they called an uptick in hostile drone activity, so drone attacks on U.S. forces stationed in Iraq and also in Syria. There were minor injuries reported, but and while the Pentagon was trying to say, these are isolated incidents, what you see there is just a more hostility toward U.S. forces in the region, and the concern there would be that the U.S. itself would be pulled into this war. The administration has been flowing military assets to the region. They knocked down 3 cruise missiles from Houthi rebels in Yemen, but you are seeing this greater U.S. involvement, and that has raised concerns that the U.S. could possibly be pulled into this. The administration is saying, no, we would not put boots on the ground, but they have been sending more fighter jets, obviously aircraft carriers. So there really is the concern that as the U.S. looks to deter Iran and other actors, that it itself could be drawn into the conflict.
Bloomberg's Nick Wadhams, who leads our national security coverage out of D.C. Thank you very much. I want to stay in the world of geopolitics, Kara, and talk about those new U.S. rules which are aimed at restricting cutting-edge technology going to China, and they've really hit shares of one name this week, which is NVIDIA. You see it there on a 5-day basis, down 9%. The worst 2-day decline in the last 2 sessions in more than a year. The US curbs threaten a fifth of NVIDIA's revenue, which comes from China, particularly in the data center context. Like, this is a stock trading at its lowest level in around a month, on track for its worst weekly decline since the week ending September 2nd. It's a timing issue, right? Because it's also a stock that was up more than 180% year to date, and been the name in AI.
And that's the context, right? How far this stock has run. And at times before, we've seen pullbacks, worries about the fact that the euphoria around this name, particularly in relationship to artificial intelligence, has just gone too far, too fast. Is it really a $1 trillion opportunity here in terms of its own market capitalization? Each time we've seen the pullbacks end up with a rally further, and you have ended up being burnt if you sold off, and goodness knows we can ask Cathie Wood about that one when she has downplayed this name since the start of the year. But it does feel like this has been a turning point in the last 5 days. And Ed, what's so interesting is you pointed out time and time again, this was not new news to a large extent. In fact, our own Ian had been reporting, well, a month or so ago, that it is likely that these particular chips designed for China would end up being swamped by what is a geopolitical context.
This week's trading has been a surprise because in June, Ian did report that the US would expand curbs to include A800 and H800, the China chips specifically, and it happened. And NVIDIA is supply constrained, right? They can just ship the GPUs elsewhere, but the market's concerned. All right, coming up, shares of Tesla could be facing one of its worst weeks after posting disappointed third-quarter results. More on that next, Caro. That stock down 15% on the week. This is Bloomberg Technology. Okay, shares of Tesla falling again today after missing 3Q sales and profit estimates, while CEO Elon Musk dialed back on growth expectations. The stock down as much as 15%, more than 15% so far this week. And as we've said on this program already today, that puts Tesla on track for its worst week of the year on a weekly performance basis. Let's bring in Bloomberg's Sean O'Kane out of Texas, who was all over these earnings. And let's just start with the basics. Margins worse than expected, missed on EPS, missed on sales. Give us the numbers.
Well, I mean, we see an adjusted automotive gross margin when removing all the regulatory credits of 16.3%. And that is a figure that everybody's been focused on all year, ever since these cuts begin. How much of that profit was Tesla going to eat into to keep demand where they wanted it to be? Now, we knew that they shut down the factories for some upgrades this quarter. We knew that there was going to be some pullback in some of those numbers, but, it all wound up a little bit worse than we were expecting. And honestly, for me, the thing that I keep coming back to is their operating margin is now down to just over 7%. And in January of this year, Zach Kirkhorn, who was at the time still CFO, said that that's actually the number they focus on the most internally as a management team. And they wanted to push in front of the street and say, hey, you should focus on this too, less about the gross margins, which are going to be a little bit volatile. And that operating margin is now lower than it has been in the last 2 years and way off its high of about 29%. So we definitely some harsh numbers. The real question now is sort of how much can they pick that up in the following quarter, where they need to push about 475,000 cars out to hit their 1.8 million target for the year. And that's definitely something they can do. It's not an enormous jump compared to the last couple quarters, but we'll see where it goes.
It's interesting that Adam Jonas, of course, one of the most bullish analysts out there in terms of price target, he's been saying, look, this is the read across for the rest of the EV market. And boy, if Tesla's hurting, then look at everyone else. He does think this is just short-term pain. Longer term, the focus is still there. They will be able to boost the overall volumes. But are people thinking this is more of a car company than a tech company at the moment, Sean?
I mean, I think its valuation still shows that people are expecting a little bit more, car company plus, I guess, is a way you could look at it. And one of the big questions, I think, moving forward in this quarter and in 2024 is we heard a lot of talk the other night about cost cutting. It really sounds like Tesla is doing a little bit less sort of boasting about cost cutting as they have in the past and coming up with innovative ways to lower the costs on their side. Now it sounds like they're really kind of racing the price cuts on the consumer side with these cost cuts internally. So can they cut more cost out of the car as fast, or at least nearly as fast as they're cutting the price on the front end. And I think it seems like they're probably getting to a point where there's no return. They've cut so much cost out of these cars until this next generation platform comes out that's supposed to be a lot cheaper to produce. So I think we're really coming to a head there with this generation of cars built on this platform that's been around for many years.
Sean O'Kane, great breakdown. We thank you. And indeed, looking at the tumult when it comes to share prices of Tesla, let's look at another Elon Musk venture for a moment. X, social media platform known as Twitter previously, is launching 2 subscription plans, with the most expensive tier eliminating ads entirely. Now, this comes as the platform begins its testing of a $1 per year subscription fee for new accounts in an effort to cut out spam and those bot accounts that Elon Musk was always so frustrated about, Ed.
So many options. Let's get some other earnings out there this week. Netflix, the streaming service, posting its best quarter for subscriber growth in years when it reported earnings the other night. The company credited the strong programming slate, but also its crackdown on password sharing. Joining us now, Alicia Reese of Wedbush. This was one of those things where we talk about all the other stuff, right? Advertising, content, strategy. And then the subscriber numbers hit and we go back to the only thing we care about, subscriber numbers. What was the main takeaway for you?
Yeah, the subscriber numbers really benefited strongly from the password sharing crackdown. You have the families who chose to add their extra members. That's $8 a month in the US and similar elsewhere. And that's grandma, kids going away to college, aunties, boyfriends, girlfriends, everyone who they want to add onto that account and didn't want to kick off. That's a nice boost for ARPU. And then all those people who got kicked off are joining for their own accounts. And often on the ad tier, but and that's pulling ARPU down a little bit, but that's really boosted subscriber numbers. And I think the most important part of the ad tier by itself is that it's reducing churn. It's giving people who would otherwise churn out for a period of time because there's no content that they really want to see and pay for. They can just lower their monthly fees and go on the ad tier for a period of time or end up staying there.
Meanwhile, like we were just talking with Tesla, they're trying to calibrate the costs of the business. And the fact that they have pulled back on content and they're releasing things more specifically, is that the right tactic to be going for at the moment, Alicia?
Yeah, I think so. Well, there are 2 things that are really benefiting Netflix right now. Before the Hollywood labor strikes, they had already reduced content costs. All of the streamers had. They're just reducing volume. And Netflix was guilty of, basically buying everything they possibly could and just seeing what's stuck on the wall. So now they're a lot more focused on quality of content instead of the volume of content, because the volume really just it makes the user, it just takes too long to find something that they really want to see, and having those quality shows there, that's what really is good for retention. So they're focused on quality, and they're also focused far more on efficiency of content, using that global content that can cross regions. Squid Game was the first major one that they saw how well that worked. And now with the strikes, they're looking at more licensed content that they haven't used this strategy in a while. They've been doing exclusive content and original content, and now recently they licensed Suits. And this is an old show, and it just, it did really well. And they're working with Warner Brothers Discovery on licensing content that is on Max. And this is no longer exclusive, but it's doing well on their program. Warner Brothers needs the money. Netflix has the viewership. It benefits everyone. It's a win-win situation, and I think that's really going to help Netflix to continually expand its free cash flow.
Yeah. Well, Netflix remains on your best ideas list as they seem to be pushing into the future as you like to see it. Alicia Reese of Wedbush, great to have you on the show. We really appreciate it. Let's speak about crypto for a moment and some of the optimism around Bitcoin once again being shown as it managed to just crack through that $30,000 level once more. This again is about the hopes that it might be able to see a spot Bitcoin ETF come to the market, if not 1, 2, but the plethora that have currently been put forward. Now, we understand at the moment that we are seeing this broader rally. We're looking towards GPTC, in particular, Grayscale's own trust. Remember, there could be a DC court ruling on that ETF application as soon as today. The SEC, of course, had asked a federal judge to dismiss its case, also against some Ripple executives at the moment, Ed, there seems to be this mood music shift that we will see grayscale prevail in the end versus the SEC backing down versus Ripple, and ultimately this all kind of hinting that we will see ETFs being adopted at some time soon, at least before January.
Let's have some more Bitcoin chat, Caroline, because our next guest is so confident about the growth of crypto. He's predicting that Bitcoin will not only breach its $69,000 high at some point next year, but go to or beyond $100,000 per token. Here in the studio, Sunny Singh, co-founder and CEO of a new company, Beluga, which has just raised $4 million, which we will get to. Why so confident? What are you basing this call on?
Yeah, no, great to have you on again. Bitcoin's become very resilient, right? And you're even seeing it today go up while the markets are going down. And next year we have what I would say is a perfect storm happening. You have three things happening. The Bitcoin ETF, which we're all talking about, the SEC is going to have to relent on this one. They'll delay as much as possible, but by Q1, Q2 next year, you'll have an ETF live. Then you're going to have interest rates hopefully coming down next year too. And then third, which I think is the most important one, is you have the Bitcoin halving happening in April. And normally after that, 4 to 6 months after, you see the Bitcoin price really run. So the last all-time high was $69,000, which happened after the Bitcoin halving 4 years ago. I think we take that out and actually breach 100,000 next year, end of next year.
Larry Fink, who is the CEO of BlackRock, you probably know, outlined this idea based specifically on the events of the last week that Bitcoin is behaving as a haven asset based on everything that's happening in the world right now. You believe that?
That's yes and no. So that's happened. It's working out this way for the last couple of weeks. But again, like a year ago and during the pandemic, it didn't work out that way. It traded just like a risk stock. And so that narrative has proven true sometimes and not the other times. I think the other three events that I laid out for next year are more importantly as what's going to drive the price up next year.
I mean, still, I think the entire market looks at Larry Fink open mouth with the about shift he seems to have had around Bitcoin, and ultimately it seems to be, he's saying, customer driven. I'm interested in what you're doing about customer driven to your new enterprise, Beluga. You've been raising funds, I think 4 million, seed capital coming in, because ultimately we talk about institutional adoption. We talk about retail, though, having pulled back. How are people using crypto other than a risk asset?
Yeah, that's the main thing. So we raised a $4 million round, which we raised in March during the doldrums of the crypto winter. But we really started Beluga to help people not only onboard into crypto, but do more with their crypto. And, you know, it's estimated that there's 400 million people around the world that own crypto, which is amazing. But only like 10 to 20 million of them are actually doing anything with their crypto. We want to help people not just buy and hold anymore, but actually stake, lend, play, earn, pay, and use crypto. There's all these new crypto products launching every day, whether it be Web3 games, crypto credit cards, new staking products, lending products, and no one knows how to use them. They're not feeling confident to want to try to understand these products at all, and that's where the job Beluga is to help get these people that already own crypto to start doing more with their crypto.
Okay, why are you doing that and not sort of legacy, traditional finance, and also the name Beluga?
Yes, great. So first, the name Beluga. Everyone in crypto wants to be a whale, and belugas are some of the smartest whales out there. So we want you to help become a smart crypto whale. Why I'm doing this, I've been at BitPay for almost 9 years, since 2014, and I was always on a mission to help people do more with their crypto. And even though I was in crypto for 9 years, when DeFi came out a couple years ago, I couldn't understand how DeFi worked. I had to Google, how do I DeFi? I ended up in Reddit and then got scared away. And there's a lot of people that are in crypto that, you know, are afraid to admit they don't actually understand how a lot of this works, and we're trying to help them do more with their crypto.
Sunny Singh, the name. We thank you for explaining, and indeed what you're all about, co-founder and CEO of Beluga. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
And we're all still here in New York, picking ourselves up after a pretty social week of engagements, because it's been officially Tech Week here in the city. It's coming to a close. Over the last few days, we've spoken with a range of founders and investors to break down what makes NYC a unique and thriving technology hub. One of those entrepreneurs and venture capitalists is Ben Lehr. Spoke to us just about his experience operating and investing in New York City. Take a listen.
I feel like every week is New York Tech Week. We are in really an explosive period of growth. And, you know, when we started the firm, New York was this sort of very tight little tech ecosystem. I felt like I knew every founder building something, and it's been this steady drumbeat for over a decade now, and it does not feel like it's stopping. And every day there's another sort of West Coast VC or, you know, VC from other market that's setting up shop and trying to hire in the market. And I think that this is an amazing place to build a company, and I don't think anyone really questions that anymore.
It's interesting that that's happening in a time in the current economic environment where people are worried about, well, the growth capabilities of certain companies and the access to capital. Why do you think it's been able to grow, bring over the Sequoias, the Andreessens, in a moment where we're kind of in a downturn?
Yeah, I think that part of it is personal decisions that founders make. This is a great place to live. It's an incredibly high quality of life. There's amazing diversity. There's so many interesting people. Every industry has some foothold here. And so, you know, it starts with talent. And I also think New York has generally had a pretty aggressive posture in trying to make this a hospitable place for companies to come and build. This is also the home of so many, you know, large industries, whether it's healthcare or financial services. You know, this is a place where, you know, media, commerce, sort of the powers that be are here. And so it makes sense to build in this market. And now with more access to capital here, I think it makes it an even better place for people to come and build.
Ben, it's interesting because you mentioned all those areas of, well, big institutions, big companies that are already, and ultimately industries that have grown here, and the thriving ecosystem around them. I mean, I think of some of the companies you backed. Oscar Health, of course, aligning itself with the healthcare industry that's here in New York. We think of Resi, a consumer company that you've backed. Again, we think of some of the other areas of the consumer, Warby Parker and the like. What is thriving here at the moment? Is it the time to be putting money behind consumer companies, given the consumer's in a worrying place? Is it more of a time for fintech to grow? Do you think it's all of the above?
I don't think that there is a sort of industry or area that is specifically, I mean, certainly for us, an area of focus. We're very early stage investors. We're focused on talent primarily. There is certainly some softness with the consumer, although I think that the reason that consumer companies are more challenging to build these days is less macroeconomic consumer issues, and actually more just the fact that so many consumer companies got built with a sort of similar playbook, a lot of the same sort of advertising strategies, a huge over-reliance on a few large social media platforms that have been flooded with brands that were flooded with VC dollars. It just grew too quickly. And so I think that there's been a big cleanup and sort of adjustment in what's happened in the sort of direct-to-consumer commerce space. These things go in cycles. You know, in my heart, I love consumer. We've done very well with consumer over the years. And while we're doing less these days than we have in some past cycles, I don't feel like that's a permanent change. I feel like that's a cyclical one. And, you know, we continue to want to find great consumer companies.
Do all companies have to be AI companies at the moment?
At the moment, if you're an AI company, it's certainly helpful in terms of how a bunch of the mid and late stage VCs and frankly, a lot of early stage VCs will view you. AI is both the most exciting, you know, change in technology that we've seen in the last decade, and also a hype cycle. You know, deals are overvalued. There's going to be a bunch of value destruction. There's also going to be some extremely important companies that get built right now. And I think, like, with anything, it's a place to play, but it's also a place to show restraint. And you need to make sure that whatever your business model is as a fund, you don't violate the principles of what your model is when there's a space that people get excited about.
Ending on the hype cycle, Leah Hippo, managing partner, Ben Leah there. And let's continue the tech week conversation. I'm really pleased to welcome Anu Dougal, founding partner at Female Founders Fund, which was born almost a decade ago, Anu. And now finally we see all the celebration of the tech ecosystem at a time that is sort of uncomfortable, because we are seeing companies having to think far more about profitability than revenue growth. How are you seeing that outcome juxtaposed with the exuberance around VCs coming here?
Sure. So, first of all, thanks so much for having me. I would say, we see this both within our own portfolio, but also in the broader ecosystem. I think there was a recent stat that came out that there are over 1,000 privately held unicorns that, I think in the next year will run out of cash. And so across the board, I think there's this push and need to really rethink your business model, because there's not a lot of growth capital out there. Unfortunately, the IPO markets, have not opened up, I think, the way that everyone thought they would. And so whether you're a late stage company or, a seed early stage company, I think the way that investors are looking at businesses has shifted fundamentally.
And so therefore you're giving an awful lot of advice to your founders, I'm sure, in this moment. What are the areas that do manage to leapfrog this so-called zombie moment? Is it the time that fintech can outperform? Is it a moment that if you've got AI adjacent, you have to suddenly really integrate that within your business model?
So I think it's imperative, for all founders to really think about AI and how they can really use it to create efficiency within their companies. I think for us, areas that we have been excited about and invested in the past year. So one would be healthcare. We were early investors in Maven, and that company has gone on to perform incredibly well, particularly in the last 2 years. And as a result of that, have really doubled down, whether it's in fertility, maternity, surrogacy, menopause. I think there's a lot of opportunity across the board. And then the other sector is climate tech. So 70% of the deals we've done this year have actually been in climate tech, ranging from a waste management software solution to, the first hydrogen-powered private plane.
What's interesting is both those things, where you reference women's health, you're also, of course, born of in the idea that there is so much underserved talent within female founders that you can allocate to over and above others. There's also, these two things are sort of becoming politicized in some way. At least allocation of funds to minority founders has, and indeed climate tech. How have you found that New York has been able to sort of isolate itself from that a little bit? Have you ever had to waver from your overall thesis?
No, I mean, I think what's been incredible to see, you mentioned in next year will be 10 years. When you think about the quality and quantity of deal flow and how that's expanded, I mean, it's been incredible to see, that not only are there more companies, but the founders, are now, some of them are second-time founders. Some of them have already had exits. And so I think that truly speaks to a broader opportunity that I think others have recognized, which is really exciting.
I know it's Ed in San Francisco. It's so good to have you on the show. And I just want to say, fantastic coverage by Caroline this week for New York Tech Week. We've kind of had the founder, the VC perspective, and also the academic perspective. And the bit that there's kind of left to talk about is what it's like to run a VC firm in New York City. VCs make money from the carried interest on the fund and the management fees. There's all these great names that have moved to New York to do that. What's it been like trying to hire these people, the associates, get more partners in?
Yeah, I mean, I think there's definitely been an appreciation for VCs, for example, that work in the Valley. And I think Ben mentioned this earlier, the quality of life in New York, the diversity of industries, diversity of people, I think has really attracted some great talent.
When it comes to talent, ultimately, of the founders that you find and the institutions that are backing them at the moment, where are you thinking about M&A as a route to exit? When you're thinking about helping these talented individuals who are potentially looking at a runway that's about to run out, do you think there will be a lot more consolidation within some of the companies that you have, rather than having to eye an IPO exit that at the moment seems to be on again and off again?
Yeah, no, I mean, I think in reality, most exits do tend to be M&A. And I think that 2024 will be a big year for M&A, because I think a lot of companies will have to seriously consider the fact that, if the IPO markets don't open, that's a real kind of outcome for them to consider. I think for us, as we look at these newer areas, for example, within climate and healthcare, where we've been investing for some time, there are a lot of acquirers, and it's a fairly acquisitive industry as well. And so that's definitely part of our consideration set.
And remind me, the founders you find, are they mainly New York based? Do you like to look at it agnostically across the US?
Yeah, so we are about 65% New York based. So we are betting big on New York. We think that, there'll be a lot of really exciting momentum in the years to come. And, majority of our exits have actually all been New York based companies.
One to watch, Anu Dugal. And of course, with those exit comes funds to reinvest within those ecosystems. And as they say, second-time founders. We thank her for joining us from the Female Founders Fund. Ed, over to you.
Yeah, terrific conversation. Alert for everyone watching the program right now. The final domino has fallen. Klaviyo is the last of the recent IPOs to now fall below its IPO price. We're trading right now at $28.92 a share. The IPO price was $30. Think about Arm, think about Birkenstock. The last holdout's gone, Caroline. I'm sorry to end Friday on a down note.
What a downer, Ed.
You talked to Anu about the short-lived IPO window, and in that moment, this really happened. Coming up on the show, KKR just closed its third tech fund at nearly $3 billion. We're going to talk about how the firm plans to invest that big money globally. This is Bloomberg Technology. KKR announcing it's closed its third tech growth fund at nearly $3 billion. It's going to focus on investing in leading growth technology companies across North America, Europe, and Israel. KKR's head of tech growth, Dave Walsh, joins us now to discuss. Dave, welcome to Bloomberg Technology. I guess give us then the description of the companies that you're looking to target, maybe more mature companies, which industries you're going to go after.
Sure, Ed. Yeah, and thank you again for having me on. Really appreciate it. Right, we think it's a really exciting time to continue our growth strategy, which we started almost a decade ago now. And the types of businesses that we're looking for, as you mentioned, are ones that are a little bit later. We like to say businesses that have actually established their product market fit, and ones that are really scaling, where an organization like KKR that has a really broad set of global resources can help bring those to bear and work collaboratively with the company to really take them often from good local enterprises to really strong global enterprises. And it's across various areas: internet, software, fintech. We probably have done the most in software. We continue to have that be a major focus of what we do. And then we have some very specific areas underneath those broad categories where we spend our time.
We're talking billions of dollars, right? You've third fund, you've done growth, you've done tech. I'm really interested in who the LPs are, because how KKR does it is you take some money off the balance sheet of KKR, but you also take outside money. And so who are those LPs? Who kind of wanted to do long-term business with you and get into tech?
Yeah, no, you're absolutely right. We've had a long history of supporting our funds with our own capital, and we did it here too with over 10% of the fund. But we do obviously have a number of outside LPs, and they're really, they range from, large pensions and endowments through to high net worth platforms and individuals, as well as, directly into the high net worth individuals themselves. And the nice thing for us, it's a very broad mix, and it's a set of LPs that have been with us over the course of the three funds. So we have a lot of re-up in the funds. Given our performance to date, and I think people, really believing in the philosophy of how we're looking to do growth equity. So it's been a nice mix of LPs. I think it's people that really see this opportunity that's ahead of us. It's obviously been a bit of a challenge time in technology and growth equity the last couple of years, but I think a bit maybe, echoing what Anu said and Ben right before me, feels like there's a very big long runway of new great companies that have been funded over the last few years that will be maturing into our sort of strike zone. And I think a lot of our investors, saw that.
Dave, I ask a sensitive question because it's a sensitive time. And of course, there is exposure when you're looking at particularly investing in security companies, cyber companies that may well be based in Israel at the moment. How have you been navigating that with founders? How have you been thinking about future investment opportunities and the worry about the ecosystem?
Yeah, no, thank you, Caroline. Definitely a sensitive question. And let me just first and foremost, hearts go out to the, the humanitarian tragedy that's going on there for sure. It's just heartbreaking. In terms of us, we've had right now two businesses, one that's actually headquartered in Israel, a business called Artlist, and another that has a substantial presence there, Sempris. And just, as we sit today, we're just in constant contact with the business to understand really what the implications are of what is going on over there, how it's impacting, them as a business and their employees, and candidly, just trying to support them the best way we possibly can to continue to navigate as things continue to unfold in the area. More broadly, we have seen and believe that Israel has been a great place for technology innovation for a very long time. And I don't think there's any reason to believe that it won't be for a long time in the future. And so for us, we will just continue to spend time there when we can, as things get back to a place when we can travel there, and continue to build relationships, because we do think in the long run, technology will continue to be innovated in Israel and be a place that we want to spend time.
Thanks so much for answering that, Dave. I'm interested in the follow-up. We just had a great conversation with Anu Dougal, who runs Females Founders Fund here in New York. And she was referencing a statistic that basically 1,000 unicorns are out there, so worth more than $1 billion, and about to run out of money. You come with this really eye-opening amount of money to be invested in growth opportunities, while everyone else is kind of worried about the growth trajectory. How do you see this current environment that we're in?
Yeah, no, it's a great call out. And, beyond the 1,000 unicorns, there are a lot of other startups that were funded from 2017 to 21 who are growing up in a very nice way and maybe haven't reached, quote, unicorn status, but are still great businesses. So this is why we think it's a tremendous opportunity to have this capital now. We think the next couple of years, there are going to be, many companies that start getting built into the next generation of big technology leaders. And so the way that we're thinking about it is just trying to be disciplined around the key attributes that we're looking for in a business. I already mentioned things like product market fit, but really strong management teams and great alignment with the management teams and boards as to their aspirations of growing the business, usually globally, where KKR can help. And so for us, it's going to be a lot about focusing our energy on piecing through those businesses that frankly probably didn't quite cut the grade, that were funded to either unicorn status or otherwise, and honing in on those businesses that really meet all those attributes that I talked about that we can partner with for 5, 6, 7 years in the future to turn them into, really large enterprises.
Dave Welsh, great to have some time with you.
A new campaign to reverse the negative narrative surrounding San Francisco and attract more companies has started. The It Starts Right Here campaign has launched by a group of local business leaders and billionaires. Bloomberg's California Bureau Chief Karen Breslau joins us now to break it down. Not new, the idea that tech billionaires, CEOs try to boost the image of the city. What is striking to you about this campaign?
I think, first of all, that it's deemed necessary, that for the first time, perhaps in recent history, San Francisco has to convince itself and the world that it's actually a cool place to live and do business.
I mean, we know that there are peaks and troughs, particularly when it comes to tech, but look, SF was born in the gold rush. Why is this time different? Why are they having to lure in and remind people of ultimately what's always sold itself?
Well, a few reasons. One is the city is, has the highest commercial vacancy rate in the United States. So about 30% of downtown buildings are currently vacant, very slow return to office, a fentanyl epidemic in the streets, record numbers of unhoused people, and I think also the social media effect. In previous booms and busts, San Francisco really did not have to contend with the amplification of its woes, and I think the city, it's basically become a character in a political drama. It's a shorthand for democratic rule, and everybody loves to pound on San Francisco and its problems.
Karen, very, very quickly, who are the names, the individuals behind this?
Well, Chris Larson from Ripple Labs, Don Fisher, Larry Baer of the Giants, and several other funders. So they put together about $4 million. And this is a campaign that's going to run for years, and it's starting now in part because the world will be coming to San Francisco in November for APEC in a few weeks.
We'll see how the world responds. Karen Breslau, great to have some time with you, Bloomberg's California Bureau Chief, all over that ad campaign. Meanwhile, that does it for this edition of Bloomberg Technology, Ed.
Yeah, just a reminder and a thank you to those that listen to the podcast, Apple, Spotify, iHeart and Bloomberg, and of course we're on YouTube. From SF in New York, this is Bloomberg.